Jared, welcome back to Your Wealth Playbook. We're going to go through all things negative gearing, what it is, how it affects Aussies, how it can be a tax outcome for your investments, and is the government going to abolish it?
Negative gearing, in its simplest term, is when you buy an investment, whether it's shares or property, and the income that you get is less than the expenses of holding that property.
You get to claim those expenses back as a tax deduction. So the government, in essence, is giving you money for holding an investment. Nice, but it could change. Jared, I've been thinking about this a lot lately and it's come up. It's pretty topical at the moment, negative gearing. What are you going to unblock for somebody who, one, has got absolutely no idea what negative gearing is, two, that it might be tripping them up, that they don't know, or it could be holding them back? Tell us exactly what negative gearing is.
Negative gearing is a buzzword. So if you think about negative gearing in its simplest term, negative gearing is when the cost of holding a property that is for investment purposes is more than the income that you make from it. So when you talk about gearing on a property, positive and negative, positive means that that property is going to make you more than what it costs you, and it's going to give you some cash flow.
More income than what you're spending on it. So the income coming in is more than what the expenses are. So therefore putting money back into your pocket. Negative portion or negative gearing is where the property costs you week to week to hold. And that could be through interest expense is going to be the largest holding. If you do have debt on it, that's going to be the largest expense. You've got property expenses, rates and insurances and any upkeep of that property. Maybe even a depreciation schedule if you've got something a little bit newer. But the government's talking about getting rid of negative gearing.
Look, it's been talked about for quite some time. If we have a look at what's happened over in New Zealand, so March 2021, they removed the ability for the interest component to be deductible against your income. So
what's that done for house prices in New Zealand if they've already abolished negative gearing? Have we got some real world data that we can go back and have a look at?
Yeah, absolutely. So between that and the restriction on foreign investors, they're back to 2019 levels of property.
6 years of negative growth, basically, is what you're talking about.
Yep.
What do you think would happen if they brought in this policy in Australia to house
prices?
I
don't think people understand it enough when it comes to how that affects not only you as an investor, but also you as a tenant. So that ability to write off some of those costs of owning that investment property in turn helps subsidize the cost of the rent, because what you're then going to see, and again, the example from New Zealand is for new property, for properties acquired from March 2021. So a grandfathered arrangement. But what you will see is you'll see another generation of investors coming into the market that from the time of that change, the interest component unable to be written off against it, you're going to see a massive pullback, or you're going to see rents go up in those areas astronomically to cover the mismatch in costs.
Would the rents go up so that the holding cost for an investor, if they can't claim that back as a deduction, their out-of-pocket expenses have increased? So therefore, to make that, equilibrium so that they're still only putting in $100 a week to it, they're going to increase your rent by what they weren't getting back as a negative or as a tax deduction from the government. Now, I can see why the government would be looking into this. I think there's a systematic problem going on here in Australia, is that the government spends way too much money. They spend more than they earn. If you go and buy an investment property and there's a little bit of negative gearing, the government's chipping in for you to hold that property, which is okay. But if they get rid of that, the government takes that expense back, plus they're also going to tax you more, because now it's going to go flip into what they would call positive geared, because you can't claim that interest back. So therefore they're going to get tax from you. So instead of helping you having a tax deduction with the negative gearing on the property and the government having to outlay money, essentially you're going to get more money back out of you as already a higher tax nation that we are, putting more money back into the government. Now, I can see a way that this would be detrimental to investors in Australia, because property prices have always gone up, and that may be due to other factors. We've talked about it before, slow builds, immigration policies coming in. So there's more people coming in than what we can currently build houses for. So supply and demand dynamics are killing us there. If they get rid of this, are we going to see 6 years of negative growth in housing prices? And what does that do for the average property investor in Australia?
I think it'd be holding up a mirror to what's happened in New Zealand. I think we are lucky due to immigration, and we saw when numbers do get pulled back, that also does have an effect on prices. But this isn't just something that would affect negatively geared properties. This would also affect positively geared properties, because that positive gearing is a cumulative effect of your income there, but also your expenses. That interest is still an expense that's on there. So it just means that property will be incredibly positively geared at that point in time. So you'd just be paying a lot more income tax on that rental income that you're receiving.
More tax dollars. Jared, should we be worried about it? I know that they've also spoken about a $3 million super tax and additional tax inside super. So they're throwing up these policies, getting people's feedback at the moment before they do go and make any changes. For me, with superannuation and clients, we aren't making any changes at the moment because it's not legislation. It's a bit like worrying about what's coming in the future. It hasn't happened yet, so there's no point in worrying about it. Is it coming? Yes. Are we talking about it? Yes. But for negative gearing, it hasn't happened yet. If it does happen, you would probably make calls. But do you think it's time to have a look at what comes next for property investors?
I think you're spot on with that unless a change has happened, there's no point in changing what your tact or your investment strategy or what your goals are, because there's no change right now. What we saw with the New Zealand situation is that those arrangements that were already in place were grandfathered. So anything prior to March 21, those properties still have their interest as deductible. So until we know more about it, there's no point in changing. There's a lot of things that are always on the table with the government that don't necessarily go ahead. So I think if you understand what it looks like moving forward, absolutely. But for right now, no.
The grandfathering is a big one, because if that was to come in and go through legislation, you can imagine every property investor in Australia would be putting their hands up to try and get into the market before that come out.
Yeah. Exactly the same with first home buyers and caps and changes. When there's a date or a definitive date, you quite often see a lot of action. If that may be, even your business owners, where you're able to depreciate an asset at a faster rate in certain years, you usually see people go out and buy more assets, whether that's good advice or bad advice, in a definitive time frame, because you've got a definitive time frame, and that's what you can work with within that situation.
Now, negative gearing isn't a strategy. It's just an outcome of investing that you can get if you are investing in property. It's not only to property, though. You can go into shares. It's any income-producing asset that you've got. You can claim back that interest expense. So it doesn't only affect property. There's other avenues that it will affect. It hasn't come into place at the moment. It's something to talk about and discuss. If you are thinking about the ways that you can negative gear and what that does for an investment portfolio, please, please, please always consider that is not a strategy. That is just a tax outcome of you investing. If you're thinking long-term, brilliant, perfect. So you should be. It's just an outcome, that tax strategy of negative gearing. So as a wrap up, nothing's happened yet. It could be a cause for concern if they did scrap negative gearing. We've seen what it does in New Zealand. We've seen the negative effects of that. So I think the government really needs to look across the ditch and have a look. You just say, it's probably not a smart policy. Let's look at other things first.
I think if you treat your investments the way that you treat a business and you treat a profit and loss item, you've hit the nail on the head in terms of it's not a strategy, it's an outcome. And I think you need to treat your investments like you treat a business. That's the way that you need to look at it. So no concerns right now, but definitely have a look at your portfolio and have a look at what your future does look like at the right now based on what the rules are right now.
Thank you for tuning in to Your Wealth Playbook. If you're watching on YouTube, make sure to like and subscribe. If you're listening to Spotify or Apple Podcast, hit follow and drop a 5-star rating and share this episode with a friend.
Help us reach more people and enhance the financial knowledge of our families, friends, and communities. Have a great day. We'll see you next time. Just a reminder, the information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. Before making any financial or investment decisions, you should consider whether the information is appropriate for your circumstances and seek professional advice. Past performance is not an indicator of future performance.
If you'd like to discuss any of the points mentioned today in more detail, reach out to us directly and we would love to help and have a chat.